get in. Another important market was Rahul Singh, Chief Investment Officer for Equities at Tata Mutual Fund, joins us right now on the show. Rahul, it's been a while, but good having you. Thanks much for taking the time out, and congratulations on your new role. I would seek advice from you on that front itself. How would you be approaching your investment or investing your clients' money in light of the fact that we've had a stupendous up move, not just yesterday, but over a 4-day period, anticipating this election verdict?
Yes, hi, good morning. I think our philosophy, our investment philosophy, which in general terms is called growth at reasonable price, but what I would like to segment it into is two parts. One is we look at value, but we look at value with triggers. And secondly, we look at catalysts for earnings upside or earnings surprises vis-a-vis consensus. So really, I mean, nothing really changes from that perspective. I think one big realization we've had over the last 5 years of having this strong mandate at the center is that there are parts of the economy which do well or don't do well irrespective of having a very strong government at the center. And let me give you examples. I mean, we have seen last 3.5, 4 years of this 5-year tenure of the last government, that the banking sector NPA problem took 3 to 4 years of that 5 years to get resolved, and it's only in the last 6 months or 1 year that we are seeing some activity on that front. Similarly, on the private capex side, we are seeing some green shoots 4 years after we had a strong government. So obviously there are certain things in the economy, there are certain cycles in the economy which have taken much longer despite having a strong government, and that should be a good sobering thought for anyone who wants to jump in and buy at this stage. Having said that, I think some of the segments which I mentioned, like green shoots in private capex, corporate banks, we continue to like, and we continue to like not for the reason that we will have a strong government at the center, but for the reasons which I just mentioned, which is that things seem to be turning around, and there is a potential for earnings surprises in these couple of sectors. And I think that's what we look for, and nothing changes to that extent. Having said that, what obviously changes from a fund flow perspective, if we have a good result on May 23rd, is that obviously there is a feel good and the fund flow kind of picks up, so which kind of makes things challenging for us to generate outperformance or to start finding or to keep finding stocks at reasonable value. But that's part of investing, and I don't think that is going to change as long as we have easy liquidity conditions across the world.
Okay, Rahul, let's try and dissect this. The heaviest space, which is financials, has chalk and cheese behavior. The expensive ones have gotten even more expensive now, especially post the up moves that we've seen. I mean, you don't normally see the HDFCs, etc., move up 6-7%, but combined market cap of the HDFC twins over 10 lakh crores, Bajaj Finance knocking at new highs, 9.5 times, 10 times price to book. We have those valuations right up there. Growth at reasonable price would entail that you don't look at those names. Somehow, those are the ones which are moving up. How do you approach investing in financials? Because that's the biggest bucket right now in terms of weightage.
Well, you're right. I think the second factor which I mentioned, which is the fund flow and the kind of allocations to India, which tend to go up on events like these, are what are driving the frontliners, as you can see for yourself. Yesterday, there very little difference between the increase in the Nifty and Sensex and the small cap and mid cap indices. So you can clearly see that the tide of the wave will first hit the large caps, and then it will go to the mid and small caps, and that's one way to look at it. That's the technical part of it. But as I said, we are focusing more on even within financials, there are sectors or there are pockets of financials which are much more reasonably priced, where there are tailwinds in terms of some of the older housing finance companies, for example. They are benefiting from what's happening to the new generation HFCs, corporate banks I mentioned. So there are pockets where you can be overweight within the financials and not necessarily chase some of the names which I mentioned, which are also having visible growth. So look, it is not for no reason that that these banks are doing well and the stocks are doing well, because what's happening in the NBFC space is also resulting in some kind of a market share gain or a market share comeback for some of these banks, which was not the case over the last 2 to 3 years, when NBFCs could grow very rapidly because of easy liquidity conditions over the last 2 to 3 years. So banks are making a comeback, not only from an NPL stress point of view, but also from a market share point of view in the retail segment where NBFCs were making a huge dent. So I think it's a combination of the two, and that's why you are seeing some of the banks which you mentioned, which are perceived as retail banks, also doing well because of the way the dynamics have changed between NBFCs and banks.
What is the biggest threat to this current up move that we've seen? Obviously, the biggest threat in the most immediate term is a reversal of the results that we saw in the exit poll. But keeping that aside, if it's status quo in terms of the election day results, what is the other biggest threat that you envisage for this rally to come to a halt?
Well, as the previous guest was also mentioning, I think there are some pending issues on the NBFC liquidity squeeze. I think we need to see how the new government comes to terms with solving that liquidity crisis, because it should not turn into a solvency crisis, and that's where this rally could have some issues if the liquidity crisis becomes a solvency crisis. The second is on the budget. I think because we have seen consumption slowdown over the last 3 to 4 months after the last budget was presented. So we need to see how the fiscal deficit pans out when the full budget is presented, whether the 3.4% number fiscal deficit sticks or does it slip, because a lot of assumptions on the tax collections, etc., would have been contingent on economic growth assumptions and consumption growth assumptions, which have definitely taken a downward tick. And that's really something to watch out for. And once the dust settles down after elections, I think the focus will very quickly shift to these two issues, in my view.
Okay, Rahul, we'll leave it at that. Thank you so much for taking the time out and speaking to us today. And once again, congratulations and all the best in the new role.
Thank you.
That's Rahul Singh of Tata Mutual Fund, talking about his thoughts on the markets and the way ahead. Well, sticking to big voices with the exit poll suggesting the favorable outcome for Narendra Modi's government for